This is your Swap Hunt Daily News for March 10th, 2026. Strategy just dropped over $1 billion on Bitcoin, and altcoins are sitting at stress levels not seen in years. Markets are showing tentative recovery today after weeks of heavy selling, though sentiment remains deep in extreme fear. The total crypto market cap has moved higher alongside a broad bounce across major assets. Bitcoin is trading above key moving averages for the first time in several sessions, but volume and conviction remain thin. Altcoins are seeing marginal relief after reaching historic stress levels, with nearly 4 out of 10 tokens trading near all-time lows. It's a cautious bounce in a still fragile environment. Strategy has made another major move, purchasing 17,994 Bitcoin for $1.28 billion. The buy brings the company's total holdings to 738,731 Bitcoin, roughly 3.7% of the entire Bitcoin supply. This acquisition follows an even larger buy in January, when Strategy added 22,305 coins in a single week. The firm has now invested a combined $56 billion in Bitcoin. The purchase was funded through sales of STRC and MSTR equity, a financing structure that lets Strategy effectively convert stock issuance into Bitcoin exposure without taking on traditional debt obligations. It's worth noting that Strategy's average acquisition cost currently sits above the market price, leaving the full position in unrealized loss territory on paper. That hasn't changed the playbook. Michael Saylor has made clear that market volatility doesn't alter the thesis. Also worth watching, digital asset treasury company BitMine has been running a parallel accumulation strategy, adding nearly 61,000 Ether last week alone. BitMine now holds 4.5 million Ether, or roughly 3.76% of total Ethereum supply, putting it within reach of its 5% supply target. Both firms represent a structural shift in how large organizations are treating crypto assets, not as trading positions, but as long-term treasury reserves. Blockchain data reveals that traders collectively accumulated close to 600,000 Bitcoin during the recent dip below $70,000. That's a significant volume of demand appearing at a specific price level, and it's exactly the kind of on-chain signal that technical analysts watch closely when assessing whether a correction is finding a floor. The accumulation pattern suggests that the dip attracted a broad base of buyers rather than a single concentrated move. When buying activity of this scale appears in on-chain data across a compressed price range, it often indicates that participants viewed the level as attractive relative to their expectations. This doesn't guarantee a reversal, but it does shift the short-term demand picture meaningfully. Separately, a single trader on Hyperliquid is holding a position worth approximately $194 million, leveraged long on Bitcoin and Ether near current prices. Whale-level conviction at these levels, combined with the broad accumulation data, paints a picture of strong buying interest emerging after the recent pullback. Whether that demand is sufficient to hold price above key levels will become clearer as macro data drops this week. Bitcoin held on centralized exchanges has dropped to its lowest level since early 2019, according to a CryptoQuant report. Approximately 2.7 million Bitcoin now sits on exchange platforms, down sharply from prior years. The decline accelerated after the FTX collapse in late 2022, when users pulled over 325,000 Bitcoin into self-custody, but the structural driver since then has been institutional absorption. Spot Bitcoin ETFs have absorbed roughly 1.3 million Bitcoin since launching in January 2024. Corporate treasury programs have added another 1.1 million coins collectively. Together, that's close to 5% of total supply that has moved off exchanges and into long-duration institutional custody. The implication for market dynamics is significant. As exchange supply shrinks, the available float for spot trading compresses. Thinner exchange liquidity can amplify price movements in both directions, making markets more sensitive to demand surges or sudden selling pressure. For longer-term holders, the trend is broadly constructive. Supply leaving exchanges historically correlates with reduced selling pressure, but it also introduces structural risks around liquidity if conditions shift rapidly. This is a supply story playing out slowly, and it's one of the more consequential structural developments in Bitcoin's market architecture right now. BitMine Immersion Technologies has made its largest single-week Ethereum acquisition of 2026, adding approximately 60,976 Ether to bring its total holdings to 4.5 million tokens. That represents 3.76% of the entire Ethereum supply, putting the company's stated target of 5% within reach after 8 months of systematic accumulation. The firm's total assets now stand at $10.3 billion, split between Ethereum holdings and $1.2 billion in cash. BitMine CEO Tom Lee framed the current environment as a mini crypto winter phase that he believes is nearing its end. He pointed to Ethereum stabilizing above $2,000 this week as a constructive signal. The company's strategy mirrors what strategy has done with Bitcoin, using equity capital markets to fund ongoing accumulation of a digital asset at scale. BitMine's chair also referenced analysis from Tom DeMark of DeMark Analytics, who identified parallels between Ethereum's current price structure and historical market downturns, flagging a potential window of volatility through mid-March. The firm is pushing forward regardless, treating short-term price action as secondary to the longer-term supply thesis. When a single entity holds nearly 4% of a network's token supply, their buying and selling decisions carry real market weight, a dynamic worth tracking closely. The broader altcoin market is under severe strain. According to a CryptoQuant report, nearly 38% of non-Bitcoin, non-Ethereum cryptocurrencies are currently trading near their all-time lows. That means almost 4 out of 10 alternative tokens are at their most distressed price levels since launch. The altcoin market cap has collapsed from peaks near $450 billion in early 2022 to around $170 billion today. Despite a partial recovery in late 2024 and early 2025, the sector has fallen back below critical moving average levels, including the 50-week and 100-week averages, both of which are now sloping downward. The 200-week moving average sits near $200 billion and represents a key structural threshold that altcoins have recently failed to reclaim. Several forces are driving this sustained underperformance. Institutional capital has been flowing into Bitcoin ETFs rather than the broader token universe. Tighter macroeconomic conditions have pushed investors toward more established assets, and the sheer expansion of the crypto asset universe has diluted attention and liquidity across a far larger pool of projects. Historically, extreme all-time low readings have sometimes marked later-stage selling exhaustion. But without a meaningful shift in liquidity conditions or macro sentiment, altcoins may remain in prolonged compression while Bitcoin continues to absorb the majority of new institutional demand. U.S. Bitcoin exchange-traded funds recorded $167 million in net inflows on Monday, marking a return to positive flow territory after weeks of persistent outflows. The shift is meaningful. ETF flow data has been one of the most closely watched indicators of institutional demand, and a positive print after an extended bleed offers some relief. But the picture across the broader crypto fund landscape is more complicated. Ethereum, XRP, and Solana ETFs all experienced net withdrawals for a third consecutive day. Altcoin-focused products continue to lose assets even as Bitcoin regains traction with institutional allocators. The divergence reinforces a theme that's been building for months. Institutional crypto demand is becoming increasingly Bitcoin-specific. Advisors and fund managers who drove broad crypto ETF inflows during the initial launch period appear to be narrowing their allocations toward the flagship asset. For altcoins, this isn't just a price problem, it's a structural capital allocation problem. As long as institutional flows favor Bitcoin ETFs over altcoin products, the liquidity rotation away from the broader market is likely to persist. Whether Monday's Bitcoin ETF inflow marks a genuine trend reversal or a one-day bounce will become clearer as the week's macro data lands. That's your Swap Hunt Daily News for March 10, 2026. If this kept you informed, subscribe to Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.